make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Today's podcast is sponsored by NetSuite, the easy-to-use cloud-based business management software for every aspect of your business. Download the CFO's Guide to AI and Machine Learning at netsuite.com/gold. The guide is free to you at netsuite.com/gold. Today's podcast is also sponsored by Shopify. Shopify is a platform designed for anyone to sell anywhere, giving entrepreneurs like myself the resources once reserved for just big business. Sign up for a $1 per month trial at shopify.com/gold, all lowercase.
The Peter Schiff Show.
Well, I am back from my trip to Orlando at the Money Show. It's been 1 week since I did my last podcast. And during that week, the price of gold rose by another 3%, hitting a record high almost every day that I was away. And it continued this week. Gold almost got above 2,750 today. I think we settled at about 2748. We're maybe 2746 right now as I'm doing this podcast on a Tuesday night back here in Puerto Rico. That's a 3% move in the price of gold, $80. Silver, as I've been saying, made an even bigger move. It popped by more than 10% just in the week since I did my last podcast. Silver closed at $34.90, almost $35 an ounce. It was $3 lower last week. And, of course, last week I announced the special at Schiff Gold on junk silver. And that was a popular special. I'm glad a number of people got in, especially the second day, because we had like a pullback, a gift horse. Silver was down like 30 or 40 cents the day after I announced that special. So I did on Tuesday, I think on Thursday, we had a pullback for who knows why, because gold was up and set a record high that day. But for some reason, silver pulled back, and that was a gift horse. So the people that got in are sitting pretty right now. But if you missed out, we were extending the special. And if you remember, the special is we're selling these silver $half at the same price that we sell the dimes and the quarters. And we've never done that before. They generally sell at a pretty big premium. So if you buy a full bag, that's 10,000 face, you can get it at $1.95 over spot. And that is the same price that we would be charging for dimes or quarters. So get your silver, don't wait another week. And I come back and it's $40 an ounce. But again, in the scheme of things, it's probably not going to matter whether you paid $35 or $40 an ounce, because I believe we're going much, much higher. But you might as well pay $35 because you could buy extra silver. And that's what's really going to make a difference. Not that you got the lower price, but the lower price enables you to acquire more ounces for the same amount of money. So that special, they've extended it. So when you're finished listening to the podcast, go over to Schiff Gold and get some silver, get some of these junk silver $half, while we can still get the price that we negotiated. But, more important too than what's happening in gold and silver is why, the significance of what's going on. Because, these are important metals. So it's not that you could just ignore it and not understand, right? Like, what does this mean that gold is going up so much? People like to talk about, the Dow is up. Yeah, but it's down like 5% this year, priced in real money. You can't just ignore that. Also, what's significant, and I was predicting this, and I don't really know anybody, at least in the mainstream media, who predicted this. That's why they're all so, baffled by what's going on, and they're coming up with explanations which are wrong. But bond yields now on a 10-year treasury closed at 4.21 today. That's up just over 50 basis points from where the yields were when the Fed cut short-term rates by the same amount. The same thing with the 30-year. The yield on the 30-year, when Powell announced that 50 basis point rate cut, 30-year treasuries were just under 4%. They're like 3.9596, something like that. Now, they're exactly 4.5%. Again, a 50 basis point move, probably the opposite of what the Fed expected, right? Because they wanted to lower rates because they wanted to bring down borrowing costs. Instead, borrowing costs have gone up. Mortgage rates now are getting close to 7% again, the opposite of what the Fed was hoping to achieve. Credit card rates, of course, never came down, and now they're at new record highs. I mean, I think they're 23, 24% for credit card rates. And of course, people now have record high balances that are now being financed at those record high rates. But this is not a surprise to me. I was on this podcast and even on my appearances. I know I said this when I was on Fox Business and whatever else interviewed me. I said that when the Fed cuts rates, short-term rates, that's going to be the bottom in long-term rates, and they're going to go up. And that's exactly what's happening. Long-term rates and gold prices are rising in tandem. And that is the opposite of what most people think. They think, oh, higher interest rates are bearish for gold, but gold is going up anyway. Now, since the mainstream financial media did not expect this to happen, they thought that when the Fed cut short-term rates, that long-term rates would follow instead of going the opposite direction. The excuse that they are making for what's happening in long rates is they're saying that, well, the economy is not as weak as we thought. And therefore, long-term rates are rising because we just found out that the economy is not as weak as we thought. And so maybe the Fed won't cut rates as much as we thought. And so now the longer end is backing out some of the rate cuts that they had priced in. And that's a bunch of nonsense because the economy is not stronger than we thought. It's actually weaker than anybody thinks. They're basing this idea that the economy is unexpectedly strong pretty much wholly on the non-farm payroll number, the most recent one that we got, that was way ahead of estimates. But that jobs report was pure BS. I went over that on the podcast that I did immediately after the jobs report was released. It was not a strong report. It was another weak report that was masquerading as a strong report. And the superficial strength was hiding the underlying weakness. We have a weak job market. And of course, whatever that number was is going to be revised down. But even if it's not, we hired a bunch of government workers. That weakens the economy. And, a bunch of waiters and bartenders with part-time jobs. These are not good jobs that people are able to support a family on and pay off their debts and save for their retirement. So we still have a weak economy. That's not why rates are rising. Rates are rising for the same reason the gold price is rising. It's because the Fed's rate cuts are a mistake. The inflation genie is not back in the bottle. We're going to have rising inflation. We're going to have skyrocketing fiscal deficits. So bigger budget deficits. We're going to have more supply of treasuries hitting the market, which, as I've said, are going to be monetized. I said the reason that the Fed is going to go back to quantitative easing, and I've said this since before they cut rates, when I predicted that the rate cuts would result in rising bond yields, I also said that eventually the Fed would end up going back to QE to try to get those bond yields to go down, because I knew that the rate cuts alone wouldn't be enough because they were inflationary and they were bearish for bonds. So if the Fed really wants bonds to go down, it's going to have to buy the bonds itself. But of course, first it has to stop selling bonds, because that's what it's doing now. It's selling bonds, and a lot of other people are selling long-term bonds. You'd have to have your head examined to want to buy a long-term U.S. Treasury, even at 4.2%. Inflation is going to be well in excess of that. That's what the gold market is saying, loud and clear, except nobody is paying attention, at least, in the mainstream, because inflation is going to be much higher. And that's why the gold price is rising the way it is. And that's why bonds are falling, because inflation is bearish for bonds and bullish for gold. And so they're doing exactly what you would expect that they would do if you understood the predicament that the U.S. economy is in, and if you understand basic economics and finance, which of course nobody does if you're in the mainstream financial media, and most of the mainstream investors don't really understand what's going on. That's why they're not buying gold and silver. That's why gold and silver, even though they're rising steadily, they're not like soaring, right? Because there is no panic to buy. It's a very orderly, methodical rise that's happening day after day after day with minimal corrections. And you're not seeing any, blowout move in the mining stocks. Yes, finally, we have new 52-week highs, multi-year highs in the GDX and the GDXJ. The next key resistance is to really take out the 2020 COVID high. Even though gold itself and now silver, both metals are higher than they were in early 2020. Neither of the gold stock indexes, or there's more than two, but none of the gold stock indexes have taken out their highs yet from early 2020. That's coming up. That may happen this week. And then I think it's off to the races. By the way, I wanted to point out, as everybody is talking about how, the economy is stronger than expected, the only economic data points that have come out so far this week, Richmond Fed manufacturing came out today, -14, bad number. Yes, not as bad as the -21 from the prior month, but it's another minus, another negative number. And it just continues this manufacturing recession. But also, I thought what was significant is we got the leading economic indicators for September, another negative, -0.5, which was bigger than the downwardly revised -0.3 from August. It was originally reported as -0.2, but they revised it and made it worse. And -0.5 was worse than the lower end of expectations. They were looking for anywhere from +0.1 to -0.3. But what's really significant is Joe Biden has been president and Kamala Harris has been vice president for 45 months. And during those 45 months, we've only had 6 months out of 45 where leading economic indicators were positive. And I think 4 of those 6 happened like in the first couple of years, right? So in the last 2 years, we've had 2? But 6 out of 45, that's 13% of the months have had a positive number. I don't think that's ever happened. I mean, I'm confident that's never happened over a 45-month period. That in any, ever since they started keeping track of these indicators. So how can we have such a great economy if the leading economic indicators have been flashing, recession for 87% of the months that Biden and Harris have been in office? So the idea that bonds are rising because the economy is strong, no. And in fact, I heard more people again say that, well, the strong economy means more inflation, and so that's also pushing up bonds. No, a strong economy would normally mean lower inflation because the strong economy would produce more, which would keep a lid on prices. It's weak economies that result in more inflation because they result in more stimulus. They result in more money printing. Government revenues go down, their expenditures go up, they have bigger deficits, they print more money. So weak economies are historically far more inflationary than strong economies. That's what's going on. It's not about a strong economy. It's about strong inflation and a huge supply of bonds for which there are few buyers. And I'm going to get to more of that after this break. We're going to talk about the BRICS Summit, which is another reason I think that the dollar is going to come under a lot of pressure and why bonds are already under pressure. So don't go anywhere. We'll be right back. As a business owner, I know the challenge of navigating unpredictable markets, interest rates, and inflation. That's why having the right tools are essential. NetSuite streamlines operations and scales with growth. Over 40,000 businesses have already future-proofed their businesses with NetSuite by Oracle, the #1 cloud ERP. NetSuite brings accounting, financial management, inventory, and HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. When you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. Whether your company is earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. NetSuite is the platform that I would choose, and you should too. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/gold. The guide is free to you at netsuite.com/gold. That's netsuite.com/gold. All the talk, though, of a stronger economy driving bond yields higher and causing the Fed maybe to cut slower than the markets had anticipated has caused some buying in the dollar, which bounced off. It was down around almost ready to break through 100. And now it's back above 104. So we've had a 4% rise in the dollar. It's been strong across the board against other currencies as it's been weakening against gold. But the fact that the dollar has gone up by 4% and gold has also gone up means that in terms of other currencies like the euro, the pound, the yen, the Aussie dollar, the price of gold has gone up even more than it has in US dollars, which is actually even more bullish for these mining companies because most of their costs are in Canadian dollars or Australian dollars or South African rand. So the profits of these companies are rising even more because in terms of their cost structure, gold prices are rising even higher than they are in dollars. But I think this is just a short-term phenomenon. I still expect the dollar to roll over and break below 100 and go significantly lower than that. Interestingly enough, Bitcoin has gone nowhere since my last podcast a week ago. I mean, it's been hanging out around the same price. Right now, it's around 67,200, but that's about where it was when I did my podcast. Now, over the weekend after I did my podcast, we did get above 69,000, which was a 6-month high. And then we came back down. But it's interesting. I'm watching on CNBC on Monday morning when gold is, gapping up to a new record high and silver's up. And not only did they not mention gold at all or silver on Squawk Box, but they did mention Bitcoin. They said, oh, look, Bitcoin's at a 6-month high. Big deal. Gold was at an all-time record high, yet it wasn't even worthy of a mention, yet they pointed out that Bitcoin made a 6-month high. Big deal. So what? It hasn't done anything. 6-month high. There was a significant event going on in a significant monetary metal, yet they only focused on an insignificant event happening in nothing, in a digital token. And I was also watching, was it the next day, they were talking about, they had a guest come on. Maybe it was the same day, but this guest came on and he started talking about the melt up in the stock market and how like the stock market's just going to keep going up. It's going to melt up and you just got to buy, stocks are going to go up. But they ignored the fact that the market was actually melting down if you price it in gold, that the stock market was down that day and it was down this year if you measure it in real money. Now, I actually agree with what this guy is saying in that, yes, the stock market will likely keep rising in dollar terms. because inflation is going to be so rampant. Yes, prices are going to go up. That includes the price of stocks. But the price of groceries are going to go up more, right? The supermarket is going to see better returns than the stock market. That's why people should, load up on food, because the food that you store will probably beat a lot of the stocks. But that's what gold is telling you. It's a meltdown that's being disguised by inflation. Again, that's one of the reasons that politicians like inflation, because people feel like they're richer, right? Their stock portfolios are going up. They're getting a raise, right? And so they think things are good because the numbers are bigger, but it's all an illusion, right? They're actually getting poorer while they think they're getting richer. This is what the politicians want. The politicians want voters to think that they're better off, so they'll reelect their leaders, right? They don't want to be honest and say, yeah, things are lousy, because then it's okay, well, we need to vote for somebody else. So they create inflation, and one of the extra benefits of the inflation they create is that it creates this illusion because of these bigger numbers. Now, when gold hit 1900 in 2011, right? It started this big run because it was at under 300 in 2001. So it was a huge move. And, early on in that move, I put out this post on X because I had remembered, because CNBC was like not giving a damn about the price of gold because they weren't even talking about it. And so I posted this clip that it's like a minute and a half clip, but I went on Squawk Box back in the day when I was a regular, and they nicknamed me Dr. Doom because I was forecasting this financial crisis. And I'm on with Mark Haynes, and gold is $495 an ounce. It's actually down that day, but it's $495. And I say, the last time I was in your studio, because most times I did the things remotely, but I said, last time I was in your studio, gold was $60 an ounce lower. This is a big move. That's a big loss of purchasing power. And Mark Haynes is like, who cares? Why should I care about the price of gold? What difference does it make, right? It's meaningless, right? Well, they didn't care about gold when it was $495 an ounce. And now that it's $2,750 an ounce, they still don't care about it because they have no idea what it means. Or if they do, they certainly don't want their audience to figure it out. But when gold got to 1900 in 2011, right, it was a big move. And gold didn't have any real big pullbacks then either, except for 08. When we had the financial crisis, we had almost a 30% decline. Gold went from about 1,000 to 700 and change. But when the Fed showed his hand and announced QE, gold took off. And because initially people, not just me, I wasn't the only one. There was a chorus of people who were saying, this is terrible, right? There's going to be massive inflation. You got to buy gold. QE is going to be a disaster. The Fed is making a mistake. Now, all those people were right. But so gold took off because of those initial concerns. But after gold kind of peaked out and there was some profit taken, all of a sudden, investors got convinced that the Fed pulled off a miracle. And there wasn't going to be inflation, that we were able to print all this money and do all this quantitative easing, but there wasn't going to be any inflation. So all the guys like me who were warning about inflation, we were all wrong. I remember Paul Krugman called me out by name back then and took a victory lap. Peter Schiff was wrong. He was warning that QE was going to cause inflation, and see, we have no inflation. Well, first of all, I never said that QE would cause inflation. I said QE was inflation. And there's a big difference between the two because we had inflation. It just didn't show up in the consumer price index. Now, one reason was because the consumer price index is designed to hide the price increases. So we actually had a much bigger impact on the CPI, but the numbers weren't honest. But of course, a lot of the inflation in the early days of QE went into stock prices, went into real estate prices, went into bond prices. So asset prices were being pushed up by inflation. But nobody cared about that. Everybody was happy about that. But I knew all along, and I was telling my audience, that all this inflation would eventually come home to the consumer goods. That regardless of how the inflation entered the economy, it always ends up in the same place, because everybody who's buying assets eventually wants to buy stuff. I mean, that's why people buy stocks, so they can buy more stuff. Owning stocks are a means to an end. You're trying to get wealthier. You're trying to accumulate more money. Why? So you can buy more stuff. And so everybody wants to turn their paper wealth into consumer goods, whether it's buying a new house, buying a car, taking a vacation, buying new clothes, entertainment, whatever it is. People want to spend money. And so I knew ultimately that's the final resting place. All this QE, all the money that was printed, eventually it's showing up, in consumer prices. And that finally happened in a big way in 2021, 2022. It's finally here. Paul Krugman was wrong. I was right back then. QE was inflation, and now we are having to suffer the consequences of all that inflation. But when it comes to gold, gold has gone sideways for 13 years. This is not 2011. We're nowhere near top. This is like 2001, when gold finally broke out of a 20-year bear market. We went sideways for 13 years. And during that 13 years of sideways action, that's where Bitcoin came, because Bitcoin and all the Bitcoin pumpers were able to say, look at gold's gone nowhere. We've printed all this money. We've done all this QE, and gold hasn't gone anywhere. Well, that's because gold already went up. It already went up from 270 to 1900. And then it went sideways. But that didn't mean it wasn't going to have another leg up. Now it's happening. Now it's just starting. And gold has a long way to go to catch up to where it needs to be based on how much money has been printed over those 13 years. Now, some of it was already factored in early on, but the people who were worried about QE1 and QE2, they had no idea what was coming with QE4, with COVID, or what's about to come now, after this election. And by the way, the odds on Trump are now the highest I've seen them. If you look on the betting markets, Trump's about a 60% favorite. I'm looking at Kalshi right now. But all the odds are pretty much the same among all the major platforms. But Trump is at 60%. I've never seen him that high. This is the highest today. That's one of the reasons that a lot of the Trump trades, like, Donald Trump's stock was on fire, below 10% today. The stock has been soaring just in line with the odds of Trump winning. It's the betting markets where you see Trump way ahead. In the actual polls, it's more of a dead heat, or I think Kamala is actually leading in most of these polls, which is why I think a lot of these polls are kind of rigged. I think probably the betting markets are more honest because it's actual money that's being bet. And so it's like, who do you think is going to win? It's not, loaded questions where they can, play with the sample and how they ask the questions. So the betting markets are probably more accurate. So as I've been saying from the beginning, I think Trump is going to win. I've thought that, from, before Biden dropped out, but especially after he survived that assassination attempt. And I thought it, kind of elevated him to the status of a living American folk hero. I couldn't imagine anyone beating him, especially someone like Kamala Harris. But it's interesting because everybody knows that Trump is, bullish for Bitcoin, and Bitcoin's gone sideways all week as the odds of Trump winning have gone up, and a lot of other Trump-related stocks have gone in the direction that you would have thought they would go, whether it's up or down, depending on whether they would win or lose based on his policies. Yet Bitcoin hasn't gone anywhere, which should raise some concern, although the Bitcoiners are not concerned about anything, that now that we've had the Trump trade and it's not going up, maybe that means that all the speculative money that is buying Bitcoin for a Trump win has already bought it. And now, if Trump does win, we might have a Trump dump as opposed to another Trump pump. Anyway, got one more commercial, so stick around. We're coming right back. When you think about businesses growing their sales beyond forecasts like Feastables by Mr. Beast or even a legacy business like Mattel, sure, you think about a product with demand, a focused brand, and influence-driven marketing. But an often overlooked secret is actually the business behind the business that makes selling and, for the shoppers, buying simple. For millions of businesses, that business is Shopify. Nobody does selling better than Shopify, home of the #1 checkout on the planet, and the not-so-secret secret with Shop Pay that boosts conversions up to 50%, meaning way less abandoned carts and way more sales going. So if you're into growing your business, your commerce platform better be ready to sell wherever your customers are scrolling or strolling on the web, in your store, in their feed, and everywhere in between. Businesses that sell more sell on Shopify. What I love about Shopify is no matter how big you want to grow, Shopify gives you everything you need to take control and to take your business to the next level. Upgrade your business and get the same checkout that Mattel uses. Sign up for your 1-month trial period at shopify.com/gold. All lowercase. Go to shopify.com/gold to upgrade your selling today. Shopify.com/gold. By the way, since my last podcast, Trump has come out with another scheme to potentially buy votes. He was asked about whether or not he might exempt certain other individuals from paying federal income taxes. Remember, it's no taxes on tips, no tax on overtime, no tax on Social Security. And now he was talking about no taxes on policemen, on firefighters, on active military, and on veterans. It's tens of millions of people that Trump is saying, hey, they shouldn't have to pay federal income taxes at all. Now, of course, look, I don't think anybody should have to pay federal income taxes. But in order for that to be true, we have to slash government. Government has to be a lot smaller because we have to pay for government. And so I want a small government. And with a small government, nobody has to pay an income tax. But if you want a big government, then we need a lot of taxes, and so income taxes right now is one of them. And so Trump is still promising all kinds of tax cuts to voters when the government is broke and needs the revenue. Because if we cut taxes, we're just going to run bigger deficits. The deficits are more harmful than the taxes. When people talk about, if we raise taxes, it's going to hurt the economy. Not necessarily. If we raise taxes and we get smaller budget deficits, they'll actually help the economy, because the deficits are more destructive than the taxes. Now, the best thing to help the economy is to cut government spending, to really substantially cut government spending. But I don't think that's going to happen. And, the tariffs, Trump now also came out and he says now he wants also a 20% across the board tariffs, which I prefer across the board tariffs rather than targeted at particular countries, because a lot of those tariffs backfire and the government doesn't end up collecting the revenue. People just buy from the countries where they don't have the tariff and just pay a higher price than they would have paid if they bought the tariffed items. But it doesn't generate any revenue for the government. It just makes consumers pay more, but the government doesn't get tax revenue. But if the taxes are across the board, well, the government's more likely to get revenue because, no matter who you buy from, you're going to pay the tariff. But again, it's the people, the buyers, the American consumer that pays that tariff, not the foreign producer. He just passes it on, just like sales taxes. When you go to a store, the store doesn't pay the sales tax. You pay the sales tax, right? Same thing with value-added taxes. We don't get a free lunch because we're getting hit with an excise tax. That's the whole point of an indirect tax. The public pays indirect taxes indirectly, but you still pay them. A direct tax, you pay directly. That's where the names come from. So an income tax, a payroll tax, those are direct taxes. You send your money directly to a government. Tariffs and sales taxes, they're indirect taxes. You don't pay the money to the government. You pay the money to the importer. You pay the money to the store. And then the store or the importer sends the money to the government. You pay the tax indirectly. So Trump is being, disingenuous, claiming that it's the Chinese that are going to pay these tariffs. But one thing I think the tariffs are going to do, and I think that's significant to this BRICS summit that I want to talk about, because that BRICS summit started today and it's going to finish up on Thursday. And I'm going to talk more about it on Friday. I'll probably do a podcast on Friday, and I'm going to talk about what happened at the BRICS Summit, because so far I have no idea, because I haven't read any stories about, what's been decided at that summit. But it's a very significant event that, again, is being completely overlooked, really, by the mainstream media that think, oh, who cares what's happening in Russia, right? It's like no big deal. But one of the things that the tariffs are going to do is increase the incentives for the world to ditch the dollar and move away from the dollar. Because one of the main reasons that China, for example, has propped up the dollar is because so many Chinese companies are selling goods to Americans. And if the dollar crashes, well, the Americans can't afford to buy the goods anymore. And so they want to keep the dollar strong so their companies can keep earning strong dollars by selling their goods. And, but I've always thought that was a mistake, because it's really just vendor financing. We can't afford to pay for the goods, so you need a better customer. It's not worth preserving customers that you have to loan them the money to buy your stuff indefinitely, because they're never going to pay you back. But this has been going on. But if we start hitting tariffs on all these products, making them much more expensive for Americans to buy, Americans won't buy them. And so if it's much harder for Americans to buy foreign products, then how are foreign companies going to earn dollars by selling to Americans? They're not. See, Donald Trump just thinks, well, they'll just eat it, right? If we put a big tariff, these foreign companies are just going to pay the tariff and not raise their prices. Well, then they're going to lose money. The businesses will lose money. They're not in business to lose money. They're in business to make a profit. They're not going to sell to America if the business is losing money. Now, the country as a whole was losing money because they had to buy treasuries and prop up the dollar. But the individual business still earns these dollars that maybe the government taxed all the citizens through extra inflation or whatever to prop up. But when the individual companies start losing money, then it doesn't matter. The American market becomes irrelevant because nobody can afford to buy. And so now the Chinese start looking for other markets to sell their products to. And so why bother to prop up the dollar? And of course, the flip side of the dollar as the reserve is, how do you earn dollars? You export to the United States. You run a trade surplus, and then you earn dollars and you build up your reserves. Well, if you're not building up your reserves because you're not earning dollars because Americans can't afford to buy your stuff, you just move away from the dollar. And, there's more rhetoric, too, out of the Trump camp. They keep looking. Donald Trump looks at all these countries that have trade surpluses with the United States, which is basically everybody. And they'll say, oh, look, even Ireland, right, is taking advantage of us. We've got a huge trade deficit with Ireland at our expense, like the Irish are ripping us off. He's got it backwards. They're actually providing us with a subsidy because we're not actually paying for this. He looks at it like he's a businessman, and he's saying, hey, Ireland is a company, and they're generating all these sales, right? And they're making a lot of money selling us products, but our companies aren't making money selling them products. But they're not really selling us anything. They're basically giving us these products because we're not really paying for them. We're just printing up money. And so we've been exploiting Ireland and everybody else. Right? Trump doesn't get that. And he also thinks if we just put up these tariffs, okay, great, we're going to make the stuff ourselves. Trump is right. The fact that we have all these imports and that we're so dependent on foreigners is a sign of a fundamentally weak economy, structurally weak economy that needs to be fixed. But just erecting walls isn't going to fix the underlying structural problems. And if we try to keep out the foreign products, our standard of living is going to crash because without those products, we just don't have them. There is no way. Trump says, oh, all the factories, all the companies are going to start making stuff here. They can't. Not now. We don't have the factories. We don't have the infrastructure. We don't have the supply chains. We don't have the trained workers. We don't have the ability. That's gone. And so there's a lot of things he doesn't get about how this is going to, the repercussions of this. But anyway, getting back to this BRICS Summit. So it's being held in Russia, right? Which is supposedly, right, oh, we've got sanctions against Russia. The whole world is supposed to be, staying away from Russia, blackballing Russia. They're the bad guy. Putin's the bad guy, right? Leave him alone. Yet you have all these leaders from other countries, from China, from India, South Africa, Brazil, Egypt, United Arab Emirates, Iran. All these leaders are now, in Putin's, backyard. They've come to Putin, right? So they're obviously not boycotting him. They're all there. And what is the primary goal that these nations have? It's to distance themselves from the United States dollar. That is the main agenda. Right? They want to trade with one another without using dollars. So when China buys something from India, they don't want to pay for it with U.S. dollars. They don't want to use the U.S. dollar in these transactions. And they don't want to hold U.S. dollars as a reserve for their currency. So they want to come up with another system that basically eliminates the need for dollars. This is a big, big deal because now more than ever before, we need China, India, Russia, all these countries to buy dollars, to buy our bonds, because we have bigger deficits than we've ever had. We have to sell more bonds every day, every week, every month than we've ever sold before. And we need buyers. But the buyers are saying, we don't want to buy. We're trying to figure out how to run our lives without your dollars, right? Without your treasury. So we're moving away. They're going to create their own system. I don't know how they're working. I have a pretty good feeling that gold is going to be a part of whatever they do. If they come up with a new basket or a new trade currency that they could use to settle all their deals, it may include gold and some other basket of their currencies, right? Their own currencies. The dollar won't be part of it. The euro won't be a part of it, right? They're going to have their own trading block. And if you think about these countries, first of all, the population that you're talking about, I mean, when you get India and China together, I mean, that's a huge population. Those are the two largest countries by far in the world. But then, you throw these other ones in there and think about the resources. It's not just the energy that you have in Russia, in the United Arab Emirates, in Iran, but the minerals that you have in China, in South Africa, in Brazil. So these are resource intensified economies. And so this is a huge potential threat to the U.S. dollar and its place in the world. And we're ignoring that. And also part of the impetus to move away from the dollar are the sanctions against Russia. And it's not an accident that the BRICS Summit is being held in Russia. I mean, they could have held it in any one of these countries, but they held it in Russia. That is basically a thumb in the eye of the United States because they're saying, hey, we don't care about your sanctions. You know what you can do with your sanctions? We're going to Russia. And by the way, the Russian economy is doing fine. The ruble is doing fine with all these sanctions. We didn't impose the economic chaos that we thought when the sanctions were first put on into Russia. But what we did is we galvanized all these other countries that don't want to be the next Russia when it comes to sanctions. So if they move to gold, which is why they're buying all this gold, we can't sanction their gold. If they own gold and store it within their own borders, we can't do anything about that. Yeah, if they hold U.S. treasuries, sure, we got them by the balls. That's why they don't want U.S. treasuries. But the problem is, who's going to buy them? Because we have to sell so many of them. I was listening to an interview today with Paul Tudor Jones, right? He was on CNBC. I mean, he's a good guy. He's a smart guy. I mean, probably one of the smartest ones out there. And we have very similar portfolios. He's invested heavily in gold, commodities, foreign stocks. So we have a lot of the same things. I mean, he owns Bitcoin and I don't own any. And I disagree with him on Bitcoin. But I know that he's in Bitcoin for a trade, right? So he's trading it. He's speculating in it. And I'm sure his position in gold is far larger than his position in Bitcoin, but I really don't know anything about the size of those positions. But he talks about the fact that he owns gold and that he owns Bitcoin and other commodities. But one of the things that he was saying is that we need to inflate our way out of the debt problem. Like that's a positive. Like that's like his prescription. Like we have this big debt problem, and his prescription is, well, we need to inflate our way out of this problem. Now, he said we needed some tax hikes, and he talked about maybe 10% hike in the income tax, letting the Trump tax cuts expire, a 1%, an extra 1% payroll tax. I think he recommended delaying the retirement age or bumping it back, but probably not for people who are retired now or who will be retiring soon, right? People who are going to be retiring in 20 or 30 years. So it doesn't really help the situation today if you raise the retirement age from 65 to 70 for the 20-year-olds who are 40 years away from retirement anyway, because we have a crisis right now, not in 40 years. But he proposed some tax hikes. But then he said that the Fed needs to offset those tax hikes by cutting rates and doing quantitative easing. But what's the point, of raising taxes if you're just going to do that? You're just, losing the benefit. But he said that we need inflation because we have to run negative real interest rates. He says we need interest rates to stay below the rate of inflation. And then we need the economy to grow by more than inflation so we can bring down debt to GDP. Right? Because we can have the economy growing more than the debt. And one of the reasons he says we have to do that is we have to keep the debt service costs down. Because if interest rates go up, it's too expensive. We can't pay the interest. Right now, the interest on the national debt is $1.1 trillion. And, I used to say it was the third biggest line item. I was mistaken. It's the second biggest because I was lumping Medicare and Medicaid into one program. And they're not. And so there's only one program, Social Security, that is bigger than interest on the debt. Interest on the debt is the second line item. And obviously, if rates go up, which they should do, it's going to be even bigger. But it's bigger anyway because all this debt, all the bonds that the government sold when rates were 25 basis points, 50 basis points, all those bonds are maturing. And now they have to get rolled over at 400 or 500 basis points. So as we refinance the existing national debt, the interest bill is exploding. Plus, we have to finance the trillions of additional debt that we take on every year to fund the ongoing budget deficits of the United States. And so Tudor Jones was like, the Fed has to lower rates. And so he said that all roads lead to inflation, which is true. They all do lead to inflation. But that is not the best thing. We should not be advocating. Look, I agree. That's what they're going to do. They're going to try to inflate away the problem, but they're going to inflate us into a bigger problem because the markets are not going to cooperate. When the markets realize that this is our plan, then they're going to want to participate. Right? If you know that the value of your treasuries is going to get inflated away, why would you own them? You won't. The only reason people own them is because they think they're not going to get inflated away. The Fed is committed to 2% inflation, and okay, I'm getting a 4% yield. At least I got 2% real yield because the Fed is committed to 2% inflation. But if you know that the policy of the United States is to have negative interest rates and inflate away the value of the bonds that you're holding, why would you hold them? You won't. There will be a run on U.S. Treasuries. There will be a run on the dollar, and the inflation will run out of control. See, Tudor Jones said we have to run higher inflation. We just can't let it get too high. Well, you can't control that. It's like, well, I only want to get a little bit pregnant. No, you're going to get all the way pregnant. And if we do what Tudor Jones is suggesting, we're going to have runaway or hyperinflation. What we actually need are much higher interest rates. Now, Paul Tudor Jones points out rightly that, well, we can't afford higher interest rates on all this debt. And so we have to keep interest rates artificially low so we can service the debt. That's not the solution. The solution is we can't pay the debt, so let's default. That's a better solution because then interest rates can go up because they have to go up. The underlying problem in America is that we don't save enough and we don't invest enough and we spend too much, particularly on consumption. We borrow to finance consumption. That has to stop. We're living in a bubble. And the result of that bubble is this massive debt that's about to explode. Tudor Jones wants to keep that from popping. You can't. What we need is to take control of the popping rather than having the markets impose the crisis. We need to default on the debt. Now, that doesn't mean that we give bondholders zero. Let's say we decided that we're going to give everybody 50 cents on the dollar. Well, we cut our national debt in half in one stroke of a pen. Now, yeah, that's going to be tough luck for the people who had $1 million in treasuries, and now they only have $500,000 in treasuries. But the losses will be smaller than the losses that Paul Tudor Jones wants to impose by inflating away the debt. The debt holders lose no matter what. When you talk about inflating away the debt, you're inflating away somebody else's assets because America's debts, treasury debts, debt bonds are held by somebody. Somebody owns them. That's why Paul Tudor Jones said he owns no fixed income. Of course, he's talking his book. He wants the Fed to create inflation because he's loaded up with gold and commodities. And he said he owns zero bonds, no bonds at all, because he knows that if you own bonds, inflation is going to destroy you. So when you talk about inflating away the debt, you're inflating away somebody else's assets, somebody's life savings, somebody's pension, somebody's annuity, the value of an insurance policy. There will be massive losses when you inflate away the debt. Because again, one person's liability is another person's assets. Well, once the people who own the assets that we are going to inflate away realize that that's their fate, they're not going to play along. They're going to sell. It's like if you know you're on a sinking ship, you're going to get off, right? Right now, a lot of U.S. bondholders don't realize that the ship they're on is going to sink. That's why they're still there. They think it's seaworthy. They believe, Captain Powell, that he's going to do whatever it takes to keep the ship afloat and make sure inflation is 2%. When they realize that we're going to sink in a sea of inflation, they're going to abandon ship, right? They're going to sell their treasuries, and that means the Fed's going to have to print even more money. They're going to have to crank up the presses even more, and then it creates even more inflation. And as I said on the last podcast, that's a self-perpetuating spiral of debt and inflation. No, we need to be honest, right? The leaders have to say the country is broke. We can't afford to pay back what we borrowed. And so if you loaned us money, you're not going to get it all back. But again, they're not going to get it all back anyway. There's two ways our creditors are going to lose. One is through an honest default where they get fewer dollars. The other is through inflation where they get all their dollars, but they have less purchasing power. And I think that bondholders are going to end up losing more if they hold on to inflation than if we just default. But the problem is a lot of them won't hold on, right? Before they lose too much money, they will sell. They're not going to hold these 30-year bonds till maturity. They're going to sell them. The question is, who is going to buy them? Nobody. Nobody is going to want to buy these bonds. Everybody is going to want to sell these bonds. So bond prices are going to crash and interest rates are going to soar, the opposite of what Tudor Jones wants to happen, unless the Fed prints the money to buy them and then prices soar. But again, and I pointed this out before, then what happens to corporate bonds? What happens to muni bonds? Because those rates are really skyrocketing because the government's not buying those bonds. Oh, yeah, well, maybe they will buy those bonds. They may start. There may be a lot of pressure, certainly from the municipalities. Could you imagine all these states, right? They have all this municipal debt where they borrowed money at 3 or 4%, and all of a sudden they have to pay 10 or 15%. They don't have the tax base to support that, and they don't have a printing press. So the Fed is going to have to bail out all the municipalities and all the states. And then what about corporations, right? It's going to be a print fest, right? And then there's going to be a mass exodus for the dollar. And again, it doesn't matter who wins the election as far as that's concerned. I think it matters for other reasons. I want Trump to win, and I think it's important, but it's not a panacea at all. We're going to have much higher inflation, much bigger deficits. We're going to have a crisis regardless of the outcome of this election. I would just rather have Trump's team in office when it happens than the Harris team. Not that I'm 100% confident that the Trump team is going to do the right thing. I'm just 100% confident that the Harris team is going to do the wrong thing. So that's basically where we are, right? And so we have to take the lesser of the evils and hope for the best with Trump. But things have got to get a lot worse. See, he's trying to get elected, making all these promises. Everyone's going to pay lower taxes and the economy is going to boom. We can't, do that, right? It's like, if you want, he's saying you can go to heaven, you don't have to die, right? No, I mean, you got to die. That's the problem. Now, the economy doesn't have to die, but we're going to have to go through a purgatory. We're going to have to go through some real austerity. Things are going to have to get worse if they're ever going to get better. The politicians are promising that they're going to get better immediately, and that's impossible. All we can do is blow more air into the big bubble and hope that we can blow it even bigger. But what's happening right now in the price of gold, what's happening with these bond yields, this says that you can. And in fact, since all these things that I've been predicting are happening, right, with rising bond yields, with the rising price of gold, this stuff is a sign that we're near the end of the rope here, right? It may not be the ninth inning of this game, but we're close, right? And what should happen from here out is basically what I've been, predicting. I mean, all you have to do is go back and read The Real Crash, which I wrote in 2013. That shows you how long. But I wrote in that book what was going to be happening. And what's happening right now is what I said was going to happen. I didn't know when. I didn't have a timeline. I just knew that the day of reckoning was coming for the money printing, and all the deficit spending, that we were going to get to the point where we're at now. The only thing that hasn't happened is the dollar. So the bond market has rolled over. Gold is broken out. The dollar is still hanging on. And we'll see what happens. Maybe the nail in the coffin will come as a result of this BRICS Summit. Maybe the catalyst will be the results of the next election. But once the dollar starts to go, then it's the trifecta. Then you've got bonds falling, the dollar falling, gold rising, and then that's it. And then, things are going to accelerate in this process. Anyway, that's it. Again, I'm going to do a podcast, I think, on Friday, once we find out what actually happened at the BRICS Summit. Don't forget, if you're not now a subscriber at Schiff Sovereign, go over there. We've been putting out some really good free newsletters at Schiff Sovereign. So go to our website and sign up. Don't forget about the silver special at Schiff Gold. I mentioned it at the top of the podcast. I'll just mention it again in case you forgot. You want to go to schiffgold.com and take advantage of the deal that we got on junk silver $50 while we still got that price locked up. Anyway, bye for now.